Felix here. Markets are tanking today, and the Fed is planning the pivot of the pivot on the market to pull the rugs from under your feet. And how and why is important to understand, so you know what's happening between now and the end of the year at least. We're going to jump into that. Before we do that, last day, promise you, NASDAQ benchmark. All 100 stocks in the NASDAQ, ROIC numbers, earnings per share numbers, forward-looking earnings per share, debt levels, all that sort of stuff. It's all in there. It's all good. It's all free. felixfriends.org/NASDAQ. We keep putting these out to make you smarter investors. So let's jump straight into this then and say this isn't financial advice. No, it's not. It never is. It never has been. It all comes from my golden retriever. He's very, very clever, but maybe don't let him pick your stocks. So to start with, as a baseline, you might be aware of it, but if you're not, the retail sales numbers today came in very, very juicy. 1.3% up month on month. We were expecting them to be about 1% on the headline numbers, and we were expecting them to be about half a percentage point on the ex-automobile numbers, but even on the ex-automobiles, it's 1.3%. So people are not buying a lot of cars, it seems. That's one way of looking at it. But what is the market doing with that information? Well, they're saying, look, that means the economy is stronger than expected. A stronger economy means what? A strong consumer means higher demand, means higher inflation, and that is bad all around, right? Because that means the Fed's going to do more. And the Fed's talking. Fed Bar talking today. We've got Waller talking today. We've got Williams talking today and tomorrow. They're like a boy band on a sort of, inaugural tour to meet every teenager in the country who will listen to them. That's what they're doing. So we've got John Williams here saying, he bruised sentiment after saying the bank should avoid incorporating financial stability risk into its considerations. Basically saying, we don't mind breaking stuff. It's fine. We're going to keep hiking, which is sort of like a stick your head in the sand kind of an approach. Total madness. Mary Daly also saying a pause is off the table. And Goldman Sachs, those lovely vest-wearing bankers with the white noses, are saying we're now going to get 5 to 5.25% interest rates, up from their previous 4.75 to 5%. So this is a reversal of what happened last week. Last week, everybody thought, no, we're not going to go above 5%, and now we're back to it. How does that happen so quickly? Well, the stronger retail numbers, says JP Morgan, the world's largest American bank, a bit like the World Series, only the US plays in it. And they're basically saying the stronger retail numbers give the Fed more room to be aggressive. Aggressive is not a word we like because we get more interest rate hikes. Our stocks are worth less. We don't really like it. But there is always a but. The consumer spending is slowing down. Did you watch Target's earnings today? An absolute calamity. They got $1.45 of earnings per share. We're expecting 2.15. Ouch, that's an ugly miss, right? The EBITDA, the profit target, 1.7 billion. We were expecting 300 million more. In fairness, that might have been stolen, quite literally. They're saying they're losing about $500 million to organized theft. You know those gangs of 14-year-old youths who run in and grab everything, randomly run out again because they can't be prosecuted because they're under the age? That's organized crime. Welcome to the madness. So they've cut their Q4 top line and bottom line, and the stock is down something like 15% or so. We put a trade out on that this morning for you guys on the community. There is a little bit more I want to talk to you about unemployment and so on. Before we do, just a quick, the problem with us retail investors is most of us haven't got the faintest idea what we're doing. I used to be a banker, so I kind of see it from a different perspective, and I'd like to bring some of that information to you, which is what we do here, but then also we have a coaching community and so on. We're up 45% on the month. We're up 129% on the year. For those of you guys who have a 5-figure portfolio, give us a ring at felixfriends.org/coaching. Here's the link, felixfriends.org/coaching. All you need is a 5-figure or more portfolio. If you're just starting out, four-figure portfolio and so on. Brilliant, amazing. Get cracking, get started. It's the most exciting time to be. We have a course. It has 100 lessons plus. You get to see me trade live and use a less thick pen than this one. And you basically get to see me put our trading protocol into practice and how it works and how we get to these returns so you can understand how the market actually works. Write down this coupon code guarantee. There is a 90-day guarantee with the course. What do you have to do to satisfy the guarantee? Complete the course, put it into practice. That's all we ask. If you do that, it isn't for you, then there's a zero risk opportunity here to actually learn something. So check it out, felixfriends.org/options. Now moving on into the unemployment job. So the unemployment job is the following. High unemployment is good for the market at present. Why? It sounds counterintuitive, right? Well, less demand, yes, but it means it lowers inflation. The Fed has to do less. We get higher unemployment, we get less demand, therefore we get less inflation. That's sort of the very, very simple way of looking at it. And therefore, the Fed doesn't hike rates as much, and therefore stocks are going up. That's kind of what we want. That's what the Fed is saying we should get. It isn't very ethical or moral or anything like that, but that's a different story. So what we got here is the job cuts are expected to be monstrous. And where does that data come from? Well, the press, quite frankly. News mentions of jobs cuts. Meant to be an odd way to collect data, but it's pretty useful. So anything that's mentioning job cuts more than 1,000 gets into this very clever little chart here. And you can see we're at levels higher than we were in the COVID crash. So at the same time, the unemployment rate is down here. And that means there is a lot of room for that unemployment rate to pick up very, very, very significantly, and it might do it rather quickly. If it does it rather quickly, the Fed will be terribly pleased with themselves. They'll be sitting there, sipping on their sherries, going, "Oh, we made more people unemployed, aren't we clever?" So that's the way that works. But it would be a good thing for us stock investors. The other thing is that the Fed is also going to look at, these are credit card balances. Folks, if you want to hold consumer debt, I'd say don't. But if you do, don't hold it on credit cards. It's the worst place for it to be. It's up 15% year on year. So the whole saving COVID story is basically one thing of the past. Consumer is running out of money, and a lot of people are putting things onto their credit cards, unless they're just shopping at Macy's. But look at Macy's numbers. I don't think that's true. So therefore, the consumer is being squeezed, and the Fed is going to take this into account. So the market tends to swing very, very aggressively one way or the other. I think we are overdoing it on the exuberance. I think we're going to overdo it on the bearishness heading into 16th of December, which is when the Fed announces the next rate increases. There will be increases, most likely 0.5 percentage point. But what really matters is the language that they use. How hard are they going to hit us in February or March? Why not January? Because they're going skiing in January, right? I mean, sure, they have to go to Aspen. They have to have dinner with everybody. They have to meet their friends. If they're not there, they get ridiculed. It'd be very, very painful for them. So therefore, there are no Fed meetings in January. Just like there are no Fed meetings in August because they have to go to the Hamptons. So that's the way the world works. And so how can you make money out of this? Well, it causes volatility. That's what we do. We make money out of volatility. Quite frankly, most people think that options trading is some sort of leveraged extension of stocks that's incredibly risky. It's not that at all. We actually make money out of volatility, not out of stock movements. Options are broadly priced according to time, volatility, and then the price of the underlying, which could be a stock, it could be an index, it could be a commodity. It doesn't really matter as long as you understand what it is. So volatility is the name of the game that actually drives this market. Once you understand that, you look at the world very, very differently. I appreciate you watching. I appreciate you building this community. Thank you very much. We're helping literally 3,000 students we now have. We're helping to make them better investors and look after their families and be able to quit those dreaded 9-to-5s and retire earlier and better and all that kind of stuff. So to join us, you know what to do. Check it out. Links are down below in the description. And let me know what you think of this little mini crash we're experiencing here. Do you think it's the doom and gloom is back, or is the Santa rally still alive? Let me know in the comments down below. Thanks for watching.